Thank you so much for coming, and I have plenty of time for... Questions are welcome during the presentation unless they're embarrassing, in which case I prefer them after. So today I'm here to talk about a theoretical portfolio. This is not my firm's record. This is a paradigm that I've been writing about every January for the past 17 years in my syndicated column, which for about 11 years was syndicated by Bloomberg and currently is in a few newspapers and on the website Guru Focus. And it's a very simplistic paradigm. Any one of you, and frankly any graduate student in finance, could design something more sophisticated than this. However, it has extremely interesting results, and it's a high risk and high volatility portfolio, which has had outstanding results over the years. So I'm a value investor, not a growth investor. So let's start with what is value. Value, to me, is an equation. It may be an implicit equation. It could even be subconscious in your mind. But it's the price of something divided by some measure of intrinsic worth. So all of you are familiar with this measure, for example. You take the stock price, you divide by the IQ of the CEO, and you have a value measure. Of course, wasn't sophisticated enough for financial analysts, so now it's more commonly used with the stock price divided by 0.66 times the CEO's IQ plus 0.34 times the CFO's IQ. And this makes it more scientific, or at least more exact. Another measure we might discuss, since we're only a few hundred miles from Cupertino, is the stock price divided by the square footage of company headquarters, or more importantly, the number of architectural awards won by the company. Now, this is in increasing use, but the academic literature hasn't caught up with it yet. And here's a really fanciful one. You take the stock price and divide by the number of clicks that a website gets. Of course, no one in real life would use this, or would they? I'm older than many of you in this room, probably older than all of you in this room, but I remember when this was seriously used by analysts in 1999 and 2000. For some reason, not so much anymore. Now we get to some that are a little more prosaic, but actually are documented by academic and practitioner studies. Price to earnings, which is a very old staple. I remember I was a business reporter with the Associated Press in 1972 when the AP started disseminating PEs to newspapers, and then in newspaper stock pages for many years you could find the PE. Now, of course, you can't even find the stock pages in the newspaper, but you can still find the PE on the internet. Price book is very well documented, including the black studies at the University of Chicago. Price revenue, less documented, but there is quite a bit of literature to support price revenue. And price cash flow, which personally I only use as a cross-check, not as a selection metric, but it's certainly a respectable and documented value measure. And price to free cash flow may be more effective than just plain price to cash flow. For all of these, unlike the first three I showed you there is serious academic and practitioner literature that documents their effectiveness. Now, as we'll see a little later in the talk, it's one thing when you're picking on paper, and it's another thing when you're in a fiduciary relationship with clients. Implementing these approaches turns out to be quite hard, and in some ways harder than implementing growth approaches, but we'll get to that. I'm going to talk a little bit about low PE, and then we'll get to the robot, which is an exemplar of low PE in an extreme form. But let's look at some of the literature that exists on PE. One of the very earliest studies was by none other than Benjamin Graham, widely considered the father of value investing. He was a hedge fund manager and a Columbia University professor. He was, in fact, Warren Buffett's professor. And if this story is not apocryphal, and I believe it is not, Warren Buffett asked him for a job, and Ben Graham said no, too expensive, and Warren Buffett said, I'll start out working for nothing, and Ben Graham said, still too expensive. But Graham was a very interesting guy in the late 1960s. Well, actually, in the very early 70s, he published a study covering the years 1937 to 1969, which he did with Drexel. He divided all stocks in the Dow into thirds, so 10 stocks in each group. And he, what he called a low multiplier stock, what we would today call a low PE stock, returned an average of 11.77%. The Dow as a whole returned 6.63%, and the high multiplier stocks, which today we would call high PE, returned only 2.37%. So very provocative data and pretty small sample size. One of the first broader scale studies was by Francis Nicholson, who was then, I think, with Provident National Bank. He looked at 189 companies in 18 industries. His time period was somewhat similar. It was 1937 to 62, and he divided them into P's by quintile. And the performance he got is shown here. The pink bars are 7-year cumulative performance for each quintile, and the blue bars are average 1-year performance. And again, you see a fairly smooth distribution where the low P stocks, the out-of-favor stocks, did better. My friend and mentor Dreman did a study covering 1970 to 1996, 1,500 companies using the CompuStat database with quarterly rebalancing. And again, he used quintiles, as many studies do. And one of the unusual things about the robot is that it doesn't use quintiles. It really is the bottom percentile or less by PE. But Dreman found, again, a rather smooth distribution where low PE stocks returned an average of 19%. Of course, this period doesn't include either of the last two bear markets, 2000 to 2002, or 2007 to early 2009. Hence, the average returns are above the historical norm. You know, as you probably all know, historical norm for the stock market is somewhere in the area of 10%. Whether you measure for 30 years, 50 years, or 70 years, you still get something pretty close to 10%. These numbers are higher because it was a relatively good period for the market for the most part. And again, the low P stocks really excelled, and the high P stocks did really poorly. Now, why should this be? Why should low P stocks outperform? After all, a stock has a low PE for a reason. There's some problem with the company, and often it's an obvious problem. So why on earth should the companies held in low regard perform better than the companies that are in high regard, for which analysts anticipate a higher earnings rate? Well, here are some of the reasons why I think the low P approach has worked over the decades. First of all, success in the business world can be cyclical. Why? Because think of it as being a little bit analogous to a Ferris wheel. We know that the cart that's on top now, no, that's the Amazon one there and the Google one there, the Netflix one is right there. At some point, it's going to gravitate more towards the mean or maybe even towards the bottom. Why? Because the very fact that they're earning unusually high profits, excess profits, if you will attract more competition. They may lose a charismatic leader. A competitor may gain a charismatic leader. A competitor may start a new product or service that leapfrogs their product or service. They may become complacent or bloated and fall behind in innovation. Conversely, companies with low profits may get new and better leadership. They may run very lean, they may innovate, and we shouldn't overlook the fact that they may be acquired, which is, for those of you who sometimes enjoy short selling or participate in short selling, it's the bane of all short sellers that you think you found the world's lousiest company, but if it gets acquired, you're still likely to lose money on your short position. So those factors may propel companies at the bottom more towards the top. Here's another explanation of why low PE over the years has done well. This is Dreman's explanation, which you can find in his book, Contrarian Investment Strategies. I think it's on the 5th edition now. The philosophy is the same, but there's additional documentation and new slants on some things in each edition. He feels the low P effect is primarily a matter of differential reaction to earnings surprise. So low PE stocks, the company is not expected to do well. When it reports a quarter above expectations, it tends to jump. Conversely, on positive surprises, popular or high PE stocks don't go up much because a lot was already expected of them. Stocks advance by exceeding expectations. Low expectations are easier to succeed. Conversely, on negative surprises, Dreman found in an extensive study that he did with Eric Lufkin that unpopular stocks only fall modestly, while popular high PE stocks tend to plummet on negative surprises. So it all hinges on investors' level of expectations. Now, why does this matter, since it comes into play only when there's an earnings surprise? Because earnings surprises happen every day. Earnings surprises are no surprise. They're almost more the norm than the exception. Dreman did a couple of studies on this. One with Michael Berry found that analysts missed their estimates by 15% or more. I believe these were estimates made 12 months in advance in 59% of the cases. He also looked at shorter periods like 6 months and, again, very high rates of missing. So earnings surprises happen all the time, and if you have differential reaction to earnings surprise where low PE stocks react more favorably to positive surprises and fall less on negative ones, then that makes a big difference. Now, why do analysts miss so much? Not because they're stupid. Goodness knows that analysts are some of the most intelligent people around. They have lots of resources. They have good assistants. What they don't have is the ability to predict the future because they're human beings. And human beings are good at predicting pretty much anything except the future. So experts in most fields can't predict the future, and that includes security analysts. By the way, having more information definitely will increase the confidence of the person making a prediction, but it will not necessarily increase the accuracy of the prediction. I have made a small contribution to the literature on analyst fallibility in the form of another article that I do each January, usually the second or third week of January. And for about how many years? 16 years, I've been publishing a study of the 4 stocks that analysts love the most at the beginning of the year and the 4 that they hate the most at the beginning of the year. And for a little while, I was able to have good journalistic fun with this because the despised stocks were ahead of the adored stocks for quite a few years. In 2013 and 2014, the analysts had good years and caught up, so that now the average gain for the analyst darlings is about 7.2, and the average gain for the most hated stocks by the analysts is about 6.0. However, I don't think the analysts can rejoice too much about this for several reasons. One is the stocks they like the most, those that have the most unanimous support on Wall Street, have only beaten the S&P 7 years out of the past 16. Secondly, they have not beaten the S&P cumulatively. And neither, interestingly, have the hated stocks. So both the most loved stocks and the most hated stocks have underperformed the S&P, which suggests that when you're doing securities research, you should be wary of stocks where opinion is unanimous, either on the positive side or the negative side. On the negative side, sometimes the analysts are right that there's trouble ahead. On the positive side, who's left to buy if the whole world already loves the stock? So my work on this would tend to confirm Dreman's work on the fallibility of analysts and analyst estimates. Against this background, I decided 17 years ago to do a little experiment. we all think that we can pick stocks and add value compared to an index. But just as when you evaluate a weatherman, you would want to compare his or her forecasts with a naive paradigm, like a model that predicts every day's weather will be the same as yesterday's. Well, with stock picking too, we want to compare against a naive paradigm. So the naive paradigm I chose to look at was, what if you basically just took the 10 cheapest stocks in the market? What would happen? That was the question I set out to answer 17 years ago. So I took all stocks over 500 million domiciled in the US. I eliminated those with debt greater than equity to reduce the chance of bankruptcy, for one thing. Yeah.
So you eliminated all banks?
Basically, almost all banks are not in. They're about 1,800 stocks usually that meet the size criterion, and 1,100, 1,200 that also meet the debt equity criterion. Most banks would not meet that second criterion. So they aren't, for the most part of the study. And then among the 1,100 or 1,200 stocks that are left, just simply took the 10 lowest PEs. These are not necessarily stocks I like. I look at this list as a source of ideas, in my actual money management work, and sometimes I buy some of them. But whether I like them or hate them, if they're one of the 10 lowest PEs, in they go. By the way, Charlotte was pointing out before the meeting started that this is exquisitely sensitive to what database you use, because you'll find if you play around with databases a lot that what's very low PE in one database may not be in another database. Most often the difference is how they treat discontinued earnings, or earnings from discontinued operations, how they treat extraordinary earnings. Also, sometimes there are anomalies based on whether it's trailing earnings or forward earnings that you're looking at, or in the case of Value Line, they use half trailing and half forward. All these account for the same stock may have a radically different PE in different databases. For years, I used Bloomberg as the ultimate arbiter on what the PE was. More recently, I've been using Ned Davis research as a source, and this year I used Guru Focus, partly because I'm writing about them and partly because I think they have a good database. And then I used Ned Davis and Yahoo Finance as a cross-check. Yeah? Trailing. This is trailing. Absolutely. About 8 years ago, there was extreme concentration in home builders. A few years ago, I don't remember how many, there was extreme concentration in energy. And that's one reason why I don't, when I invest for clients, just buy the robot portfolio, because you get a very undiversified portfolio. But if you use it as a source of ideas, or if you have $3 million and you want to put 100,000 into this and see how it does, then that concentration is not as much of a problem. Yeah.
Also, you don't make any adjustment for cyclicality or anything like that, except it's just a simple price earnings.
That's right. That's right. It is a very simplistic measure, and it doesn't use forward earnings at all. This year, and in past years too, but I've noticed especially this year, I have a lot of stocks on there with PEs of 2 and 3, and their forward PEs are 11, 16, 18. But it's simply trailing PE. By the way, Merrill Lynch did an interesting study some years ago comparing the predictive value in terms of stock performance of trailing PE versus estimated PE. And trailing PE had higher value added. Someone had their hand up. Charlie.
I know you're not going to talk about how you do your stock selection, but for example, for 2016, how much overlap was there between the robot portfolio and the one that you use for clients?
The overlap at the moment is exactly 20%, 5 names out of 25. But let me qualify that by saying 5 stocks we own now, we got the idea in whole or in part first from their appearance in this robot paradigm, but it may have been 2 years ago or 3 years ago, because it may be a stock that we've held for 2 or 3 years.
So if I look at the robot portfolio that you'll get to, and I look at your current portfolio, it's 20% or?
20% of the names in our current portfolio were members of the robot in
But that-
2015,
but for
January.
26 But for 2016, you've got a slide, what?
I think it's 0, but when we get to the slide, I'll double check that. But 20% of them were in the robot portfolio in January of 2015, 14, or 13. So they were that was a source of the idea. And as I said, but would like to stress, this should not be confused with a real money track record. Okay, so again, it's a 3-step process. Start with all U.S. stocks over 500 million. That's about 1,800 stocks. Eliminate those with debt greater than equity. That eliminates probably about 600, 700 stocks right now, including, as you noted, Charlotte, most banks and some other financial companies. And then you simply take the 10 lowest PEs. Now, why should anyone pay attention to this? Because the results have been pretty astonishing over the years. Cumulative return, 17 years, is 1,119%, and that compares with 123% for the S&P 500. The S&P 500 here is just measured the way it normally is. It's total return, including reinvested dividends. The robot is measured with annual rebalancing. Each January, you sell the stocks from the previous year and buy the new ones. The simple arithmetic average return has been 22.9 compared to 6.5 for the S&P. The arithmetic return, however, kind of favors the robot because the robot is so volatile. Yeah, is huge. And it lost 62% in 2008, bounced back with a 90% plus gain the next year. But a 90% gain doesn't cancel out a 60% loss. However, if you're looking at simple arithmetic average, it does. So a better test would be the compound annual average, which is 15.58% over these 17 years versus 4.17% for the S&P. The robot paradigm has been profitable 13 times and had a loss 4 times, including last year when it lost 3.8%. And it's beaten the S&P 10 years out of 17. However, the margin of victory has typically been much larger than the margin of defeat. Now let's talk about some of the risk factors involved here. First of all, you correctly discerned the concentration risk. I think there was a year when there were 4 out of the 10 were steel stocks. I remember distinctly there was a year when many of them were home builders, and that was not too long before the home building collapse occurred, although I think those home builders probably performed fairly decently because the collapse didn't begin right away. There was a year when it was chock-a-block with energy stocks, and that actually would have been a good idea to buy them. We, diverging for a moment into real life, my firm invested heavily in energy stocks back when energy was $9 a barrel, $10 a barrel. And The Economist ran a cover story saying it was going to 5, but speaking of people not being able to predict the future too well, it didn't go to 5, it went to 100. So one risk factor is the portfolio is highly concentrated. I mean, even just being a 10-name portfolio, it's highly concentrated, but it's highly concentrated by industry as well. The companies all have some obvious problem, or where they wouldn't be selling for typically 5, 6, 7 times earnings. This year, 2, 3, 4, 5 times earnings. There's no diversification by style because it's all value, and there's no diversification by country because it's all U.S. And it's extremely volatile, as you'll see in a minute. In the journalistic version of this, yes, 100% of the money rolls over from year to year. Once in a while, the same stock will appear 2 years in a row. For example, Atwood Oceanics was the worst performer last year and is back in the robot portfolio again this year. Probably will do better this year than it did last year when it was down 68%. Yeah. These are the three best years. There's a 97, a 72, and a 67. And these are the three worst years. Hideous decline of almost 61% in 2008, very hard to recover from, although it did. Down 31.3% in 2007, which was not a bad year for the market, but it was a bad year for the robot. Down 3.78% last year. Incidentally, that surprised me that the third worst year was only a loss of 3, but the other two make up for it.
And this is total return?
This is total return, including reinvested dividends. And here are the year-by-year returns, which doesn't do you much good to have them up on the screen at a distance, but this is a good chance for me to say, please, if you find this topic interesting, give me your card at the end of the meeting, and I will email you this presentation, and you'll have the whole year-by-year results. And if you're really, really interested, I can send you the 17 years of detailed data with the individual stocks that the robot picked each year. It resembles Joel's magic formula in the sense of trying to hone in on a couple of essential things that the manager thinks are really important and cut through the complexity to have a very simple selection system. Now, the version of the magic number that I use, which is promulgated by Ned Davis Research, adds 2 more factors to Joel's, but I believe Joel's is just 2. I think it's return on equity and EBIT. It's earnings yield and return on invested capital, not return on equity. Okay, that makes sense. And then there's a 4-factor version that Ned Davis promulgates and I look at. So it's similar only in the sense that it's trying to say, what if you just looked at these 2 super important factors? Wouldn't you get a lot of the value that you get by staying up all night poring over 100 factors? And yeah, and I like the factors that he selected.
One other question. The society has had several smart beta presentations. In fact, I guess last March we had an entire day of smart
Oh,
beta.
interesting.
One of which is that if you take the S&P and instead of market cap weighting, if you just do it price weighting, you can outdo the S&P. It would sound as if this is just, another smart beta. It's not, I mean, it fits into that paradigm.
It fits into the paradigm, but this is much more extreme than smart beta. Smart beta changes the weightings a little. This changes the weightings radically.
But the message of smart beta is that it's easy to outperform the S&P. I mean, the easiest way is just change the weightings. When you look at it, when you take some time to look at it, you say, yeah, it beats in the long run, but you've got some pretty heart-stopping moments when it underperforms.
You're talking about smart beta now?
Yeah.
John?
Well,
Yeah.
let's say the smart beta thing is that if you move your weighting scheme from market cap and weight on anything else, you
outperform.
Right.
So
But the big fallacies are when you rebalance, what are your factors that drive your rebalancing, right? So a lot of smart beta strategies will change dramatically in rebalance in terms of what sectors they're overweight or have certain style tilts that
right, but
investors may
my
not be
point
aware of.
is that lots of seemingly simplistic paradigms will outperform the S&P.
Yeah.
But
And we're going to get to some, yeah. And I personally agree that market cap weighting your portfolio is a poor investment idea. A money manager named Arnold Schneider, who perhaps was quoted by some of the people at your smart beta sessions, although I don't think he considers himself an advocate of smart beta. He made the point that let's just assume that half the stocks in the S&P are overvalued and half are undervalued, which just as a lemma, just as an assumption, let's say that. Well, if you market cap weight, you are, by definition, likely overweighting the stocks that are overvalued and underweighting those that are undervalued. So, I like the idea behind smart beta, but I predict that if I invite you to lunch for a date 10 years from today, and we sit down and see how smart beta has done for the last 10 years, it will not have outperformed every year. Just like equal weighting the S&P doesn't outperform every year. It outperforms in years when value does better, and it outperforms in years when small cap does better than big cap. And I think you'll find a somewhat similar pattern with smart beta.
Have you considered or looked at what this data is if you, I assume the 10 names are equal weighting, correct?
Yes.
You looked at what it would be if you adjusted the weightings or if you introduced a quality component to your screen as well?
I have not. And I had hoped that academics would do additional studies taking off from this, but so far, very few have. Yeah.
If you look at the sector breakdown of the portfolio today, I would assume you see some tilt toward industrials, cyclicals, energy. And how does that tilt compare to what you've seen over the last decade? Is the column inherently loading up the truck, so to speak, on the deep cyclicals, and particularly energy? And then I'm also curious, Apple with tech, how is tech showing up in the model in terms of the weighting? Because there are legacy tech stocks that are like Apple that are selling really well.
Hewlett Packard almost made the list this year. Yeah. Yeah. Well, to answer the last part of your question first, with tech, it's typically underweighted in the portfolio because you don't see many single-digit multiple tech stocks.
Versus the Russell Value Index? Or are you talking S&P?
Well, I use the S&P, but yes, I think even if you use the Russell value, that would be the case. Energy. When I went to write this year's article, which just came out last Tuesday, and by the way, if any of you like to read my column, which appears weekly, the easiest way to find it is Google my name, or better yet, Google my name with Pittsburgh Tribune Review, which is one of the papers that carries the column, and they have a pretty good website, and they're pretty good about archiving columns, so it's easy to find my past columns, including the one on this subject, which appeared, what day is today? Just appeared 2 days ago. So in terms of energy, when I went to write the column this year, I expected, it's going to be chock-a-block with energy stocks. It's not, because, yes, well, and also because a lot of the energy stocks have losses, so they don't show up as low PE. If you have, right, there's no PE. So there aren't a lot of energy stocks in it, although Atwood Oceanics is in it again. And last year, I thought there would have been more energy stocks than there were. But the one undeniable energy stock that was in there was enough to cause the portfolio to have a 3.8% loss for the year. Without that, it would have had a gain. By the way, speaking of, but for this, the result would have been that. The S&P last year was up 1.38%, including dividends. If you take out the FANG stocks, the other 496, we're down 4 point something. I think it's 4.6, might have been 4.8, which is quite interesting. This is the results from last year, and they weren't spectacularly good, but they would have been net positive, but for Atwood Oceanics down 62%. The only other kind of energy stock in there, I'd say, is Macquarie Infrastructure, because a lot of what it builds is for the energy industry. But they did okay. They were up 7%. But the reason it wasn't full of energy stocks was because earnings had gone negative. See if there's anything else of special interest in last year's results. To your question, Charlotte, of the 10 names in last year, one of them we own for clients, which is Delta. which, by the way, is a good example of how my efforts to cherry pick don't always add a lot of value, although Delta didn't do badly, but it was only up 4% for the year. This is the current holding, and there's a typo here. I am guilty of word processing onto an old document, and that date is wrong. The actual selection date was December 31st, 2015. So these are the lowest PE stocks now, according primarily to the database Guru Focus. And you'll see that this year they are in fairly diversified industries, but there are a couple of energy stocks in here, Antero and Atwood. There's a biotech. There is a tech. Hewlett-Packard did make the list. And I'm surprised Micron didn't. Is it? Okay. Now, let's talk about what happens when you go to apply this sort of work. If you believe strongly in a value philosophy, you may still find it difficult to buy extremely out-of-favor stocks like this. Why? Well, we'll get to that on the next slide. There are emotional barriers to buying the most out-of-favor stocks. There was a study published in 2000 by Kagan and Trzezenka. They found that it's difficult to find money managers who add value relative to their style benchmark. And Haugen of University of California at Irvine went further and said, it's harder to find value measures who add value relative to their benchmark. So why might this be? Think about it. There are a lot of emotional factors at play here. If you go out and you buy the most out-of-favor stocks, let's just say you went out right now and heavily bought energy stocks, what are the risks to you as a portfolio manager? Or even if you're on the sell side of strongly recommending them as an analyst, there's a lot of career risk. You could lose your job, you can be ridiculed by your peers, you can be ridiculed by the public or the press. Buying the most out-of-favor stocks is not emotionally an easy thing to do. And by extension, to all investors, despite numerous studies that show that out-of-favor stocks outperform, investors still are drawn to the popular favorites. Their neighbor is boasting about the profits they made in Netflix. Their neighbor on the other side of them at the cocktail party is boasting about the profits that he or she made in Amazon. And is he going to say, well, I bought Muller Industries, they make refrigerator coils? It's not very sexy. And if he says, well, I bought Apache and it's down 30% so far, but I'm sure it's going to come back. It's hard. It's emotionally hard to buy the most out-of-favor stocks, even though there's a lot of evidence, including some that I showed you today, that can be an effective strategy. Also, people really tend to extrapolate recent trends indefinitely into the future. It's a common heuristic shortcut that all people are prone to. And there's the saliency effect. Some events just make a bigger impression. And the reason I have a picture of a shark up here is how many people are bitten to death each year by sharks compared to the number who are trampled to death by pigs? How many people vote for the sharks? Well, because you know what I'm getting at. But we're all very aware of the risks of shark bite. Nobody thinks about the risks of being trampled to death by pigs, even though I almost was once. But there are certain salient events that make a huge impression. The terrorist attack of 2001, for example, or, well, I think the near depression and stock market debacle of October 2007 to March of 2009 is going to still be influencing investor behavior 10 years from now because it made such a deep impression. Those of us who have parents who lived through the Depression probably remember many of their decisions being heavily influenced by their Depression experiences. How could it not be? So we may know that on paper value outperforms growth, and we may know that on paper extreme value, which is something like the robot, outperforms plain old value. But to go and do it is another matter that entails career risk and emotional risk. That concludes my prepared remarks, and you've had good questions so far. I'd love to have more. Yeah.
Over the time period you've run the robot, how many companies just went bankrupt? Didn't get bought, just became.
I may be confusing, which I always try not to do, my own experience with that of the robot, but I think the answer in each case is one company in 17 years. And the reason bankruptcy risk is a little minimized for this is, don't forget, we've eliminated all companies with debt greater than equity, so that, and we only have a 12-month time horizon here, so that reduces the number of bankruptcies. I can check on that for you if you give me your card. Yeah, yeah. It's either. I'm sure they would, but I don't know how because I haven't tried it. By the way, if you really rebalance quarterly running the screen again, you'll get a lot of different names. The screen has a high turnover of names because it represents the very extreme end of the twig, you know, on the branch. So you would be changing names quarterly as well. Yes.
Have you calculated the Sharpe ratio for the robot?
No, but the denominator would be high. Because the standard deviation here would be very high. So I guess your question is, would the risk-adjusted return be positive at all? And since I haven't done it, I'm only guessing, but yes, I believe so. But it is risk, and if you use Sharpe ratio as your measure, it would greatly reduce the gap. You know, it wouldn't be 15% versus 4.5%. It would be something tighter. But what role should high-risk stocks play in a portfolio? You know, in our case, you know, we use this as a source of ideas. One could also, if you have a big portfolio, take 5 or 10% of that portfolio, or even 15, and invest it in these stocks, and that would mitigate the risk somewhat and bring down your Sharpe ratio.
Having spent 13 years of my life as one of those maligned analysts
Yeah.
that we're talking about, how did you go about, when you talk about analysts' most loved stock versus least loved? Did you go analyst by analyst, or what did you do?
No, there are aggregation services, First Call, Zacks, and Bloomberg, yeah, definitely, will tell you you can screen for stocks followed by 4 or more analysts where the percentage of analysts having a strong buy is above 80%. And most years, my most loved stocks are unanimously recommended by 13, 14, 15 or more analysts. So those get the top spots. And then I look for the most, well, they use a 5-point scale where 5 is a strong buy and 1 is a strong sell. So you look for the lowest average rating where 2 or more people have a sell on the stock, and those are the most hated. Yeah.
Off the subject, you spent a very, very long period of time as a financial journalist, and you were a very prominent financial journalist. You were heard in the street, I think, for a long time.
I was, yes.
How did you make the transition into investment management? Do you have people asking that question?
Well, people are asking you, how do I make the transition from wherever I am now to being a money manager? I made it blindly and not knowing what I was getting into. I started my firm in my basement with $1 million under management, and it grew to 197 at the peak, and right now is 48 million because Sir John Templeton, who was an investor with me, had invested 50 million, and he died right during the financial crisis. And then we also had losses, and then we also had capital flight. So we're a long way from where we were at the peak. But when young people ask me that question now, which they do a lot, I advise them not to follow the path I did, but rather to work for a money manager. And like I say, I did that. I worked for David Dreman, and then I hung out my own shingle. It's an interesting transition. Some of the things that surprised me were the extent to which clients become nervous and upset on what I regard as a moderate market drop, say 10%. So there's more hand-holding involved than perhaps I even anticipated. And trying to find the time to spend lots of time on the portfolio as opposed to client service, marketing, and administration. That was kind of a shock. But I've never been sorry. I felt that in my years at the Journal I was quite good at it, and it's hard to feel that you have as much mastery as a money manager because every manager is going to have some tough years. And you're not going to get a straight A report card all the time. So it's a meaningful transition, but I loved both careers. And I kept a little hand in it writing through this column. Yes?
Did you ever think of adding some type of market timing, either a moving average or something to complete it from these low value stocks?
Have I thought about it? Yes, but I distrust most market timing systems. And I mean, first of all, I know I can't time the market because I proved that in front of millions of people when I was a writer for the Wall Street Journal. And also, 3 times in 17 years we've raised cash in client portfolios. And one time, which was 2008, we saved people a good deal of money. One time, which was during the Gulf War, it didn't matter because the market was very flat. The first Gulf War, I mean. And the third time was, I think, 2012. I don't even remember why we were nervous about the market, but we raised some cash and that detracted from performance. So I know I can't do it, but I know there are many systems, including what you just mentioned, the moving average systems. Would you apply that to each stock individually in order to determine when it went into the portfolio?
It would be one of the factors, so you wouldn't just pick necessarily the bottom 10.
But
Use that as another factor.
the bottom 10, where another selection criterion was that, say, the 50-day moving average was above the 200-day moving average. That'd be fascinating, and if you do it, please let me know what you find. Anything else? All right, well, I'm hanging around if anyone wants to chat, and thank you so much. I really appreciate this.